Everybody thinks that institution and institutional traders have some magic tricks to make profits on the market, read market, and take executions. But this is not true. This is just a big lie. And how do I know that? Just because I get trained from one institutional traders from one of the biggest banks in the world. So I'm just sharing with you a powerful setup that all the institutions know and use to make profit day in and day out on the market. We need to organize information to know exactly what to do in every kind of moment. So the first thing is removing all the colors. Now, the second thing, this can seem like stupid or obvious stuff, but follow me and trust me, you will get great results. We need to divide the sessions in days. So first thing first, let's put a line. You can use an indicator to do that every time the market closes, all right? Closes and opens. So this is our new day line. So now you know exactly when a day start, when a day finish. Now, the second thing, you need to know when the RTH session, so the cash session starts. So let's put a line to know that. If you cannot see, here is the line we are talking about. All right. Now, as you can see, the overnight session is much bigger than the RTH session. All right. But at the same time, as you can see, usually the movements that you have in the overnight are much smaller than the movement that you have in the RTH session. So during the cash session, you have the best opportunities and, of course, the maximum volume that you can have. So the other thing that you need to do is switch from minute-based candles to volume-based candles. So keep in mind, how much bigger is the overnight with the minute candles and how much smaller is that? Now, let's switch the candles. This is the view with volume candles. Look at the overnight session, how much is smaller and how much is bigger the New York session, right? Why is that? Because in the New York session, we have a lot of volume. So these candles can really help us to understand better what we are looking, all right? Now, the information are much better organized. So the other thing that we need to do is having a bias. How we can do that? Just set a volume profile on your chart. Now, we have a volume profile for each day. What we can do is just take the last 2-3 days, max 5 days, and extending the volume profile from the first day to the second day. So let's plot a rectangle from the previous day on the next day. And now let's continue like this. And what you can see is that the value area, so the part of the volume profile that have the maximum number of contracts traded, is in the same area of the next day. So we have a balanced market. But when you plot this day, look at what is happening. The market now has taken a direction. So we are going up. See? So now we know that we have a bias, and this bias is long. Why this is important? Because we need to know which kind of executions we want, if we want to go long, if we want to go short, and stuff like that. All right? So now that we have set our bias, we can just delete all the other days. So let's remove that. Let's remove that one. All right? What now we need to know is just the previous day. So this one, that is this area. So we can trade the actual day, that is this one, all right? Think like if this day do not exist yet. Now, another thing that we can mark on the chart is the point of control, all right? The point of control is the point where the maximum number of contracts has been traded. Now we have a clear bias and we have some zones that we can use to execute our trades. Why is that? Because when you have an area and your bias is long, you can only take execution to go outside or to be inside this area, but going from the value area low to the value area high. value area low to value area high. Of course, always have to be aware of the point of control. So this can be a point where you can scale your contracts and stuff like that. If the market is going down, but your bias is long, you can avoid this trade because this can be just fake outs and stuff like that. So this is a way to filter trades and start to use probabilities at your advantage. So now, the other thing that we can use is a very, very powerful tool. And this tool is the VWAP. Why is important? A lot of people say that the VWAP is important because it's used by the institution, but it's the opposite. Institution use the VWAP because it's powerful. Why is that? Because the VWAP is the volume weighted average price. So it tells you what is the average price. So if the average price is going up, this is telling you that the mean is shifting up, all right? So this market probably wanna go up, okay? So the institution use VWAP to execute large orders. Because if you want to execute like 10,000 contracts, you cannot just put a buy limit and buy 10,000 contracts. You need to execute partially and on the best price. What's the best price? The VWAP. So of course, the VWAP has its own power and the institutions use VWAP to load contracts, so it's even more powerful. Okay, so what we can do here, pretty interesting. So we can just wait for the cash session to open and look what is happening. During the overnight, the prices has start to bouncing on the VWAP. Look, VWAP bouncing. At the same time, is going outside of our value area. So we want to go long. We are bouncing on the VWAP and we are outside of our area. So this is a strong hint that this market maybe will go, okay? So what can we do to have a confirmation about that? This is pretty simple. We can use delta indicator, so it can be large trades, it can be a footprint, it can be delta horizontal, vertical, every kind of delta to know where the contracts are entering in the market and what they are doing, right? So in this case, we can have a look closely at what is happening in this zone, and we can see that we have people that are selling on the VWAP. They get trapped every single time. Look at here, they are selling and other people buy the market and push the market up, right? Every single time, people trap and buyers push the markets up, all right? Every time. So how can we have another confirmation? We can use a profile, a delta profile, and what we can see that every time, look here, every time you approach the VWAP, look, here you have sellers push the market down, but without results, all right? Let's go even later. And you can see, look here, in this point, you have the same behavior. So people that load sell contracts, but look, the market is not going down, right? So now that you have this confirmation, you are ready to go long because all these people, all these sellers will need to close their position. And of course, if they close their position, it's like if they are going long, right? Because of course, the counterpart is a buy contract, okay? So they will close the position and look at what the market is doing, skyrocketing up, okay? So how you can enter and exit from this market. Pretty simple. We know our point of interest is this one. You can just put your stop below here, the previous minimum, all right? Here is your stop. Your point of entry is when the market start to go up, breaking this last candle. So here is your point of entry. And now, what's your point of exiting? I think near these eyes, so you can exit here, okay? Now you have a risk reward of nearly 2, but at the same time you can do very interesting thing. so you can just trail your stop loss. That means every time the market breaks an high, make a new low, you can trail your stop. In this case, you entered here, your previous high is here. When you break it, you put your stop loss here, right? Now, you create another low here. You cannot put your stop here because you need to break the high. So when you break the high, you put your stop loss here. Now, you're going up and here you have a little high, all right? You create a new low, you break the high, so you can put the stop here. Here you create another high and another low, you break the high, so you put your stop here. You understood the game. At the end of everything, you will have your last broken high here and your stop here, and you will be taken out. So that means from a risk reward perspective, you will have your stop here, your entry here, and your exit here. So you have a 5.31 risk to reward, all right? Of course, you will choose how to manage your position. These are just ideas that you can use, but you can have a fixed one-to-one risk reward. Of course, you will have a higher win rate. You can have a 1-to-2, 1-to-3, 1-to-4, but of course, the more risk reward you will have, the less win rate you will have, all right? Of course, these things will going to balance themselves, all right? So now, this is a full strategy. So you now are ready to use it on the market. Just do a little bit of backtesting and do not use your own capital. Use prop firms. These are companies that gives you money to trade, and if you lose, the losses are on them. But if you make profits, you can withdraw the profits. All right, and everything just for a little fee of a few dollars. So I leave the link in the description with the coupon code to have the maximum discount. I leave you the link even for an academy, a free academy, totally free academy of trading. Well, I will explain more of these concepts, so you will find it in the description too. And if you enjoyed the video, put a like, subscribe to the channel, and do all the stuff that YouTubers ask on their channel. So hope you appreciate it, and see you in the next video. Bye bye.